Thank you very much for the opportunity to present here some of our findings from the recently released Chapter 3 of the Global Financial Stability Report. Before I go ahead, let me also congratulate all the winners of today's awards. Now let's move on to the chapter. If I can start with a brief motivation. So following up on the previous presentation, this chapter provides a global perspective on the role of sustainable finance, specifically investment funds, and the transition to a green economy. So we do know that the transition to a net zero greenhouse gas economy is really essential to avoid potentially catastrophic climate outcomes. And clearly there is momentum at the moment with COP26 happening later this year. We think that the financial sector has a key role to play to facilitate the transition, and specifically the investment fund sector, because it's large, it has grown a lot since the global financial crisis, and it's really at the heart of the paradigm shift towards sustainable finance. So here really, as I said, it's about the interplay between the transition to a green economy and the investment fund sector. There are, of course, also financial stability implications from this transition, and we do cover those in the report, so please have a look, but I will not cover them today in this discussion. To discuss the behavior of funds, we first have to identify what exactly constitutes a fund with a focus on sustainability. And to do that, we look at how funds describe themselves. So we go through their prospectuses and we look at their names and we label funds. In our sample, we have in total around 36,500 funds. 4,000 of those are ESG or sustainable funds. About 1,000 have a specific environmental focus, and just over 200 have a climate focus. So the overall size of the sustainable fund market and the climate funds in particular is really tiny compared to the overall market. But as you can see here, the sector is growing rapidly. Sustainable funds, environmental funds, and climate funds have all grown faster than their conventional counterparts in recent years. What we then do in the chapter is we look beyond the label at the portfolio composition of funds, and we focus on two variables here: carbon intensity and transition opportunities. Transition opportunities are constructed from Refinitiv and Morningstar data, and they reflect a company's ability to reduce environmental costs and burdens, and also company's preparedness and track record in managing carbon operations and products. Carbon intensity is our firm's greenhouse gas emissions relative to their revenues. And what we see here in these two pictures is that for advanced economies, for funds in advanced economies, both metrics have remained relatively flat. So there has not been that much progress made by portfolio firms over the past 10 years in terms of cutting emissions and becoming greener. For emerging markets, we see, however, that both metrics have been decreasing in the past few years. A word of caution is that sample issues are quite a problem here, with the number of funds being relatively small in emerging markets, and they change, the number of funds change substantially over the sample period. We then ask whether funds with a climate focus tilt their portfolios to greener firms. So we see that these funds hold indeed more securities with higher levels of transition opportunities than conventional funds. That's in the picture on the left here. So this would be in line with them actually investing in firms that support the transition. When looking specifically at the industries or the sectors that funds portfolios are invested in, we see that climate funds, so those with a specific focus on climate, they have a substantially larger exposure to firms in transition-sensitive sectors. Again, that would be consistent with these funds investing in firms that are more likely to significantly reduce their emissions in the future. So the key takeaway for us here from this slide is that climate-focused funds do indeed invest in the transition, but as we've seen in the slide before, aggregate emissions have not moved, so there needs to be done more. Then we go on and ask if fund labels are relevant for fund flows. That's an important question if we want to assess policy tools to scale up sustainable finance. As you can see here, funds with a sustainability label receive higher inflows than conventional funds, even when controlling for the actual portfolio composition of the funds. And the relevance of these labels has increased over time, as you can see here on the right-hand side. So that, to summarize, means that investors do pay attention to labels, and that underlines the potential of classification systems for making a difference. But it also underlines, of course, the importance to make sure that these classification systems actually capture meaningful information to avoid greenwashing. Then we briefly focus on two channels through which funds can influence corporate behaviors. These channels are stewardship and the supply of capital. We see that funds with an environmental or sustainability objective are more likely to vote in favor of climate-related proposals. So that's the stewardship component here on the left side. And we see that some green firms, at least, that are exposed to buying pressure from sustainable funds are more likely to issue bonds, and they issue larger volumes of bonds and equities. That's the picture on the right. So together, these two findings suggest that flows into sustainable funds can indeed help firms adopt a more climate-friendly business model. So here, then, let me conclude with a summary of the findings and some of our policy recommendations. So as I mentioned, the chapter analyzes the interplay between the transition to a green economy and the investment fund sector. We argue that the sustainable fund sector, particularly the segment dedicated to climate change mitigation, that this sector could be an important driver of the transition, but that currently is too small to really make a sizable difference. Our policy recommendations are therefore the following. First, we want to stress that there is a need to urgently strengthen what we call the climate information architecture. It consists of data, of disclosure, and of sustainable finance classifications, both for firms and for funds. If this would happen, it would facilitate the pricing of risks and opportunities, it would prevent greenwashing, and would foster sustainable or climate finance markets. Once these elements are in place, one could consider then additional tools to help channel savings into sustainable funds. So this could be, for example, financial incentives for investments in climate-oriented funds. Of course, it's important to note that those tools should be seen as a complement, not as a substitute to other climate change mitigation measures, such as a carbon tax. And with this, let me just point you to the recently released report and our also recently released IMF Staff Climate Note, which summarizes our thinking around strengthening the climate information architecture. Thank you.